Let's go to the fixed income space now with Sally Old, interest rate strategist from JP Morgan, and Stephen Nash with me in studio from Big Securities. Let's start with you, Stephen, in studio. The election, for the moment, we've just been hearing from Rob Oakeshott holding kind of a very powerful position in these negotiations. For the moment, it seems somewhat of a non-issue for bond markets. Is that your read?
I think broadly it is continuing to be a non-issue. I think the problem for the market going forward will be whether these independents ask for individual items which basically add up to a problem with the fiscal position. But I can't imagine that's going to be a main issue right now, but it's a concern going forward.
Is there a potential for a rise in the uncertainty premium for Aussie bonds coming out of this?
We've seen a small increase, but I think broadly really nothing much to worry about at this stage. 3-year bonds are trading around the cash rate at the moment, so the market's still quite bullish.
And Sally Old, what are the scenarios you're weighing up with the election non-result over the weekend, and even whether there's implications for the RBA in there?
Well, I think, you know, more broadly, I guess what is going to have to happen is there's probably now a risk that the fiscal situation at the margin could be a little less positive, in the sense that, you know, maybe some of the independents are going to demand, you know, certain things in order to get them to side with a particular party in politics. So you could probably argue that the risk of, you know, more bond supply over the next couple of years has gone up a touch. Now, whether that actually makes a meaningful impact to the level of yields is another thing, because, you know, one of the themes of our market over the last 12 months has been very, very strong demand from offshore. So it seems that, you know, any increase in supply will be met with pretty good demand. So, you know, that's probably something to watch out for, but I would guess more broadly a neutral. For yields, I suppose there is now an uncertainty premium. We did see that when the market opened up yesterday morning. We saw the market sold just on the back of the uncertainty. Although, you know, having said that, any dip is pretty well supported these days given the global environment. So it's hard to really sort of argue that, you know, yields are meaningfully higher given the uncertainty that's playing out in Canberra. But I think, you know, the one thing that's maybe reassuring markets is that all the central players in this seem to be reiterating, you know, one key theme, which is that they want stable government, and that is obviously a positive for financial markets overall. Yeah, that was the big message from Rob Oakeshott. We just heard from him a few moments ago. And Sally, you say that it's at the margins, and you also mentioned the potential changes, and you also mentioned the international investors and their participation. I mean, we're fixating on this hung parliament situation here and fixating on the numbers as they come out, but offshore investors, I mean, is the bigger picture really going to change for them if they're really the makeup of the bond market? No, I don't think so, and it's probably important to realise that, you know, although in Australia we haven't really had a hung parliament since the early 1940s, you know, hung parliaments are actually not that unusual elsewhere in the world. I mean, the UK's got one, New Zealand's got one, so maybe for offshore investors it's not that big a deal, and it's not that much of a surprise either. So, you know, I think for offshore investors at the moment, you know, given in a lot of developed bond markets, whether it's the US, the UK, Europe, yields are actually very, very low, and probably going lower given the economic backdrop. People are still looking to our market and our economy. They see a AAA rated sovereign with, you know, very few threats to the fiscal situation. They see high nominal and real yields. They see a very credible central bank, and, you know, you put all those things together, and the fact that you get sort of over 200 basis points pick up in the 10-year part of the curve versus Treasuries, and Aussie bonds still look very attractive to offshore investors. And can I get your thoughts, Stephen, as well on whether there are any implications for the RBA in here? I mean, they're still independent of the government, I suppose, but... Well,
yeah, I mean, there's been some talk that a hung parliament means a hung RBA, and I don't think that's correct at all. I think the RBA will assess matters going forward in a responsible way, as they always have. At this stage, I think there's no case for them to really move policy. I don't think they're being constrained. It really will depend on how the global growth scenario works out. Because they're still flagging the US and Europe as you know, areas to watch in terms of the global economic recovery. Sally, I know JP Morgan's just recently revised its view on the near-term outlook for the US economy in terms of growth. What have those changes involved? Yeah, that's right, Brooke. I mean, basically our US economists were looking at 3 indicators very closely, and they were car sales, the ISM manufacturing index, and jobless claims. And really the performance of jobless claims over the last couple of weeks, you know, we saw them breach that 500,000 level last week, has prompted our US guys to pretty much throw in the towel on their view on the US economy, and they've made some reasonably significant downgrades to their growth forecasts over the next sort of 2 to 4 quarters. And so now we're really looking at, you know, growth of 1.5% for the next quarter
in annualised terms, quarterly annualised terms. But we're looking at basically sub-trend growth. So along with those downward revisions to growth, we're revising up our forecast for the unemployment rate in the US. So we see it heading back to 10%. And we're also revising down our forecast for inflation, just given that the economy is going to be growing for below trend for longer than we initially expected. So altogether, not a particularly optimistic set of forecast revisions. And I think our economists are getting increasingly worried that the US is at serious risk of slipping into recession. At the moment, they think it's about a 30% chance. But, you know, a couple of weeks ago, they were putting that at 15%. So if the data continue to move in the same direction, I don't think it'll be long before that moves above 50%, unfortunately.
Yeah, they seem quite significant revisions, and you sounded a bit surprised by some of them, obviously compared to your own forecast, Stephen, or?
Well, yeah, it is significant for a major investment bank to change their forecast like that. I think going, towards the end of the week, we're going to get the speech by Bernanke at Jackson Hole. I think that's going to be very important. It's going to set the tone for the northern autumn. We've seen that the markets haven't had much liquidity of late, but I imagine as we go into that autumn session, people will be accepting that what's been going on in the bond market. That is lower growth. And I imagine some correction for equities is on the way.
Sally, can you see an outcome where quantitative easing by the Fed doesn't eventuate with that kind of backdrop that you just set out?
I think that's pretty unlikely, and in fact our US economists are now calling for more QE from the Fed. So, I'm not sure whether we're going to hear it from Bernanke this Friday when he speaks at Jackson Hole. That typically hasn't been an event where, big shifts in policy are signalled, but I guess if the Fed has a sympathetic view to our own, which is that things are getting worse, not better, then you can't really sort of sit there and fiddle while Rome burns. So maybe the risk is that we do see something pretty solid from Bernanke this week, but we certainly expect that the Fed and also actually the Bank of England are both going to engage in genuine quantitative easing before the end of the year.
Bank of England as well. Stephen, do you see other central banks easing policy through the year?
I think basically they haven't got much more to go in terms of monetary policy.
That's right.
On the quantitative side, Bank of England's already been quite significant in that area. There could be some extension from the ECB in terms of measures in that area. I think there's been some talk about that of late. So as growth expectations fall, and you've seen a recent revision down in French GDP forecast.
It was from 2.5% to 2% for 2011.
Yeah. I imagine that there'll be more talk of maybe extensions of measures in the ECB.
So ECB as well.
Yeah.
And you're particularly interested in that, the French growth forecast being revised because of that AAA credit rating.
Yeah.
And is that under risk then?
Well, look, we kicked off this European thing quite a while ago, as you know, and this is just another part of that European problem. The French are under pressure at the moment. They're under pressure to meet their deficit reduction target, and I imagine that there'll be talk of possible downgrades in that area. But at this stage, we imagine that the French will meet their targets, but that won't stop speculation in the market.
Yeah, absolutely. And Sally, I mean, bringing it back home to Australia, with what Stephen's talking about there across Europe and the United States as well with JP Morgan's forecast, that's a worsening backdrop generally for the globe. How do you see that playing out for the RBA and interest rates here in Australia?
Yeah, I think it's sort of an interesting scenario because I guess we have to constantly ask ourselves, Australia is not what it was, and, sort of 5 or 10 years ago, had we had this sort of backdrop globally, it wouldn't be spelling a particularly positive outlook for the Australian economy. But we know that, there have been some pretty significant changes since then, and really what's going on in Asia and China matter a lot more than potentially what's going on in Europe, UK and the US. So it's going to be a difficult one for the RBA. I mean, I think it probably tells you that market pricing, is looking about right, which is there's a genuine chance that the RBA is now on hold for the rest of this year. Having said that, JP Morgan economists here in Sydney are still forecasting a rate hike in November. So I think the answer is it depends, but the one X factor that it's sort of very difficult to predict and very difficult for market forecasters and for the RBA to get it right is, what does China do in this sort of situation? Because, we saw back in 2009 when the global economy was on its knees, the Chinese surprised everyone and sort of came out and said, we're doing a fiscal stimulus package, 15% of GDP, put a rocket under their economy, and it was very positive for ours. So the problem for the RBA is that they can sit there and they can worry about what's playing out in the developed economies, but in the back of their mind they'll be thinking, well, hold on, what happens if the Chinese come out and and actually engage in some considerable fiscal or monetary stimulus, that again changes the game for policymakers here in Australia. So I think it's a tough one to call, but maybe the risk is that we just see the RBA sort of sit and watch for the remainder of 2010.
Yeah, and Stephen, it's fine. It's very understandable to say we'll look at China and Asia, and that's really more what we're geared towards. But are we confident that China and Asia won't be affected by what is sounding like still quite a severe slowdown in the US and Europe? Are we convinced of that?
I think the Asian, like the Chinese, like a lot of other investment banks and global think tanks had expected, was a V-shaped recovery, and we haven't got that. So as that changes more towards a W or U or whatever you want to call it, there will be implications for the Chinese authorities, and I imagine that guidance lower in growth is probably eventual now.
And the JP Morgan's expecting a rate hike in November. Would you expect
at this stage,
at that early point?
Look, I'd say it's probably a little bit on the early side. I imagine the RBA will probably go back on the tightening bars next year, next calendar year.
Why does it need to wait a few extra months?
I think there'll be continued problems with global growth going out to the end of the year, and as they get resolved, I imagine the RBA will then look at tightening again next year.
All right, thank you so much, Stephen Nash from Fix Securities. Really good to have you on board. And Sally Old, thanks for bringing us up to date from JP Morgan.